Hi, welcome to Know It Olly ELI5's Buying and Selling Pressure, a very important market mechanic. So the first thing to remember and know is that every seller and every buyer in the market has an opposite side to the trade. If you go in and you buy some stock or you go in and you sell some stock, every single time you make or anyone makes a transaction, there has to be someone on the other side of it. So what do we mean by buy pressure and sell pressure? What buy and sell pressure means is that the number of orders, there are two order books for each stock. One is the order of people trying to buy, and the other is the order of people trying to sell. So when they're both up, trading's happening, matches are happening, people are trading, and it's all good. But what happens if, say, the buy side goes way up and the sell side's down here? There are more people that want to buy than are willing to sell. So what happens is the price starts to go up and it finds an equilibrium where you have an even number of buyers versus sellers. Say a whole lot of sellers then, hang on, we'll do that this way. A whole lot of sellers have come to the market, they've added their orders to the books, and because there are so many people trying to sell their stock, it drives the price down because people are trying to get out of their trades. When you have more people trying to buy than sell, it can shift the price around. It's just like at an auction. If you have two people in the crowd, your auction's going to be pretty straightforward. You're not going to have many options to sell your item for. If you have 1,000 or 10,000 people in that crowd, you're going to be able to push that price up because there's such a number of buyers that someone is willing to outbid someone else. The same on the bottom side. If you've got enough people on one side of the trade, it will drive the price in that direction. And so it moves the prices around. So if there aren't more retail traders on the other side of these trades, how does this happen? That's where market makers come in. Some of these huge companies that help to run the entire stock market, they have the ability to come in, and when there's too many buyers for sellers or there's too many sellers for buyers, they get to operate as the other side of that trade for the retail traders. If you want to buy, they will sell that to you if there's no one there ready to sell. Behind all that mechanic is a way that market makers can use that to make money. If they're trying to match people and there's a 3-cent difference, they can front run those orders that you and the other retail person have put into the market. They can buy it and sell it to you, and they can profit that little 1-2 cent difference between the two prices. That is how a market maker comes in, provides liquidity or money or transactions to the economy so that there is always a flow of money in different directions. But the way market makers do that is that they will try and buy stock for a little bit cheaper and sell it for a little bit more based on which direction the price is going. So each time they make those little connections, when there's no one else to match your buy or your sell, they'll make a couple of cents. However, if you're doing an order of 5,000 stock, 2 cents on 5,000 is a lot. Go up to those trades where you're trying to do 1 million to 2 million shares, and it adds up really, really quickly. I hope that explained the buying and selling side. Know it, Ollie out.